Okay, good.
Okay, let me just do a really quick introduction of Professor Coleman. So those of you who are here, you're in for a really great treat. Professor Coleman is doing a great session. I'm sure many of you saw the title. It might have been why you registered. And Professor Coleman is focused on teaching students about financial markets. He returned to the University of Chicago in 2012, first as executive director and senior advisor at the Friedman Institute for Research and Economics, and then in 2015 as a lecturer. Prior to returning to the University of Chicago, he worked in the financial industry for over 20 years with considerable experience in trading, risk management, and quantitative modeling. Professor, whenever you're ready, we can go ahead and turn it over to you. I think we did lose the screen share, though.
We did lose the screen share because I was rearranging. So let me get the, okay. So it's always a little bit of technical problems at the beginning. Okay, so I'm going to start sharing again, and hopefully we won't lose it this time.
There we go. Perfect.
Okay, so, and I'm going to go into full screen. There we go. So, welcome everybody. Good to see you. As you know, if you have questions, please put them into chat. If there are relevant questions, I may answer them as we go along. Regularly, usually in a class, it's much smaller than this. I'd like to have a nice back and forth where students are asking questions. So please don't hesitate to ask questions during the session. And if it's appropriate, I'll try to answer them during it. So what I want to talk about, and this is a lecture in the series that I give on the history of Chicago economics. And I'm talking about Milton Friedman, Anna Schwartz, and I'm talking about how they saved the world in 2008. Now that's exaggerating somewhat, but it's only somewhat exaggerating. There's truth in saying that Milton Friedman and Anna Schwartz, and in particular their book, A Monetary History of the United States, they taught the Federal Reserve how to manage the 2008 financial crisis, and they taught the Federal Reserve how to do it in a way that they did not do during the Great Depression. So what I'm going to talk about is 3 episodes which teach us about money, banking, and liquidity crises. 1907 to 08, a liquidity crisis where banks in New York restricted convertibility, and it was a depression, of severe economic recession. We're going to talk about the 1930s and the failure of the Federal Reserve to do what they should have done, which was to massively increase the money supply. And that led to just a massive set of bank failures and what we now call the Great Depression. And then in 2008, quantitative easing. The Fed did increase the money supply just hugely, and they saved, and I think there's a decent argument that they saved the financial system. Now, I'm not going to be talking about 2020 and the pandemic, but this is absolutely follows right on, because in the initial stages of the pandemic, we saw the same thing that we saw in 1907-08, in the 1930s and 2008. We saw a fall in prices. Now, that's not what we're seeing today. Of course, we have high inflation, but that's a discussion for another day. But before turning to monetary history, I want to review Milton Friedman a little bit and his contributions. And I'm going to focus on Milton Friedman's economics, not his politics. Many histories of Chicago economics, they discuss the people, the politics, the ideology, and particularly Friedman, who's, in many ways a controversial figure. He's widely remembered for his popular TV shows, his political advocacy, but I want to focus on his economics, the ideas and the concepts. And there's really 2 central themes to this, I think. The first one is taking economics seriously. Taking economics seriously is a way of thinking about and understanding our world, understanding our human behavior. And the second is applying and testing economics empirically. And this is a nice quote from Friedman. In discussions of economic science, Chicago stands for an approach that takes seriously the use of economic theory as a tool for analyzing a startlingly wide range of concrete problems, that insists on the empirical testing of theoretical generalizations and rejects alike facts without theory and theory without facts. That combination of the empirical and the theory is something that Friedman just emphasized again, and I've been reading just in the past week, his methodology of positive economics, his theory of the consumption function, and it's pretty good. Just briefly, some of Friedman's contribution to economics. We're going to be talking about monetary history. So this at the very bottom. It's maybe what Friedman is best remembered for, but he made some really important contributions across the field. In statistics, okay, the Friedman test is a non-parametric repeated rank treatments test. It's largely forgotten in terms of sort of recognizing Friedman's contributions. I happened to come across it because I was doing a project where I needed to look at non-parametric test of repeated ranked treatments, and lo and behold, Friedman test came up. Consumption function and permanent income. It was motivated by puzzles from Keynes' general theory and empirical puzzles at the time, looking at time series consumption versus cross-sectional across people. And it was what appeared to be some really contrary results, depending on whether you looked at time series or cross-sectional. He introduced this concept of the permanent income, and it's still a valid and widely used concept today. In terms of methodology, the how to think about economic theory, how to think about science. What do we as economists, how do we make and test theories? The Phillips curve, natural rate of unemployment, the trade-off, the purported or supposed trade-off between inflation and output or growth. It's a hot topic today with inflation rising. There is no inflation unemployment trade-off, okay? That's what Friedman and Phelps, Edmund Phelps, showed in the 60s. It seems to kind of come back every 10 years in terms of people thinking that there is an inflation and unemployment or inflation growth trade-off. But it relied, his argument for this Nehru or non-accelerating inflation rate of unemployment, the natural rate of unemployment, was relied on basic microeconomics. People care about real wages and prices, real prices, etc. So these are some of the contributions of Friedman. But as I say, I'm going to talk about today just the monetary history. But before we turn to that, I do just want to emphasize one thing, and this is important, I think in thinking about Friedman, but also in thinking about Harris and economics in Chicago more widely. Friedman's contributions are concentrated in macroeconomics, inflation, consumption, the theory of the consumption function, monetary history. But everything he did was built on microeconomics, on Chicago price theory, the application of microeconomics to real problems. And Chicago actually has a long tradition of using and teaching price theory. Jacob Viner taught Econ 301, price and distribution theory, from the 1920s through 1946. Friedman taught it for many years after Viner. Econ 301 is still the core and central course for microeconomics for economics PhDs. I took Economics 301 in my first year in graduate school. And it's been passed from one generation to another. So Viner taught Friedman, Friedman taught Becker, Becker taught myself. Okay, I have Alan Sanderson, colleague in the college. And if you come to Chicago, I hope I'll have the opportunity. I will have the opportunity if you come to teach you microeconomics, because that's the core course that I teach. Okay, I'm going to jump over this stuff about Heckman. It's important, but we have only a limited amount of time. So I want to talk about monetary history and these three financial crises of 1907, the 1930s, and 2008. And this is all based on a course that I teach called History of Financial Crises that I teach in the spring quarter. And this is from the syllabus. We'll examine financial and economic history using episodes of crises to learn about government debt, money, and banking. Try to understand some of the mechanisms and processes that seem to generate financial crises. Reading some of the classics as well as some of the newer texts in this area. And a better title for this course might be Money, Banking, and the History of Financial Crises, because it's money and banking which generates so many of the financial crises that we see. So in the course, I talk about the South Sea Bubble and the Mississippi Bubble from 1719 to 1720. So this early 18th century. Alexander Hamilton in the 1790s. Essentially, U.S. financial revolution. The U.S. went from 1789 being essentially a bankrupt nation to, by 1795, a preeminent nation with a stable financial system, banking system, a government debt market that was active with stable prices. It was really a truly financial revolution. But Alexander Hamilton had read, he learned from the South Sea Bubble, from the Mississippi Bubble, South Sea and Mississippi Bubbles. In the course, I talk about the US banking crises. 1907 is the one we're going to focus on, in the 1930s, and then the 2008 financial crisis. Okay. Financial crisis. The US has always been subject to banking crises. So here's a list from sort of the early 1800s from various different authors. So Kindleberger, classic text. If any of you have read Panics, Manias, and Crashes, I think is the title. Is that Kindleberger? The title of Kindleberger's book. Anyway, it's a classic text. And so he lists various different crises. Calomares and Haber is the book that I like the best, and it's taught me more than any book I've read about banking and financial crises. Reinhardt and Rogoff, classic text, published actually in 2008, not in response, but in the lead up to the 2008 crisis. Friedman and Schwartz. So these are some of the crises, but let's focus on Calomares and Haber. Okay, they say 12 crises between 1840 to the present. Okay, crisis meaning multiple bank failures. And there were 9,000 banks that failed during the 1930s. There were 3,000 banks that failed in the 1980s. Financial and banking crises are as American as apple pie. And it's just that by 2008, we'd forgotten how common and how frequent financial crises were. So here's an interesting kind of quiz question. How many, over the same period from sort of 1840 or 1841, how many crises were there in Canada between 1840 and 18? I should have put this up as a poll question. Okay. Now, obviously, I'm asking the question because it's a somewhat surprising answer. Okay. Calomares and Haber count 0 systemic, no severe crisis between 1840 and 2012 in Canada. What is it that makes Canada so different than the US? Okay, it's not cultural differences. US and Canada are very similar culturally. It's not sort of industrial or agricultural. In the 1800s, mid to late 1800s, both nations were expanding westwards, largely agriculture in the central part of the country. Okay, so what is it? Why was there this fundamental difference between the US versus Canada for a century and a half? And the answer is, I think, banking structure. US fragmented unit banking, and that's what we're going to talk about. We're going to spend a few minutes talking about this. So yeah, I see, I'm looking at the chat. Manufacturing industry difference? No, it's not. It's not. The only difference And this is what Calameris and Haber argue, and I think they make a very strong argument. The only difference that I can see really is in the structure of banking, and we'll talk about that a little bit. I mean, we'll talk about that in the next few slides. But first, we got to talk about some of the basics of money in banking. Okay. Checking accounts, demand deposits, and money. Now, we all use checking accounts, or I should say, maybe we all used to use them. I certainly use them, but they're maybe used, but you still have a bank account. Basically, paying your bills, paying credit cards, things have to flow through a bank, and you have a checking account. Okay. We use it as a convenient complement to cash. Let's put ourselves back in sort of 1907 or 1908 or the 1920s. Okay, cash was very widely used. Cash was a very convenient way of doing daily transactions. Okay, now we use credit cards, we use Venmo, we use Apple Pay. But in the 1920s, cash was it. But bank accounts and a checking account was a convenient complement, a substitute, another way of cash. Okay, and people treated them. And even today, we treat a checking account like money. We use it for transferring money, paying bills by check, etc. But there's a really important thing we've got to understand about a bank account, a deposit, a bank account deposit. When you open a checking account and you give your money to the bank, you are making a loan to the bank. Okay? A checking account is a loan that you make to the bank. You're lending your money to the bank. They're borrowing that money from you. Never think that a checking account is money that you have on deposit at the bank. No, it is a loan that you're making to the bank. Now, it's a very special kind of loan. Okay? There's two special characteristics. The bank promises to pay you back, pay me, pay us back whenever we want. Okay, I can write a check. I can go into the bank. I can go to the ATM, and that's why I think of it. That's why we think of it as our money, because the bank promises. But they are promising to pay back that loan whenever I demand. Okay, the second special characteristic of this loan, okay, because think about a usual loan. A loan would be like, you're lending money to a company and you might lend it for a period of a year. You might buy a bond from a company, which is essentially, not essentially, it is lending money to a company. Okay, for most loans, when the loan goes into default, there's negotiations, and the owners of that loan divvy up whatever money is available among themselves. So if a company goes into default on a bond, that bond is $1 million, and there's a variety of people who've bought that bond. Whatever money is available gets divvied up pro rata among the bond holders. If there's only $900,000, each person gets 90 cents on the dollar. That is not the way your loan to a bank works. When a bank defaults, it's first in line. If you're the first person there when the bank opens up in the morning, you get all of your money. If you're the last person in the line and the bank has run out of money, sorry, you get nothing. Okay? And so these two characteristics, the fact that the bank promises to pay us back whenever we want, and that the first person there gets all of their money, the second person gets all, and then by the time you move back in the line, you get nothing. These two provide a huge incentive for customers to run on the bank if there's even a hint of default. Because if there's a chance that the bank will default, you want to be there first to get your money out. Okay, so it's really important. And I'm spending time on this because it's so important that a deposit is really a loan that we make to a bank. Our checking accounts are loans to the bank. And like any promise, like any loan, that promise may be broken. Like any loan, it may not be repaid. Okay, and that's an important thing to remember about And this was particularly more true back in the 1920s. Okay, now we have deposit insurance. Banks just don't go under much anymore. And back in the 1920s, this was a real risk. Okay, but why were US banks so fragile? Okay, this is the way banks worked in the US. It was the way banks worked in Canada. Why were US and Canadian banks so different? Why was it that decade after decade, the US banks had these systemic crises with thousands of banks going under, and Canada never? Okay. Okay, so most people argue that these bank deposits, the fact that these are payable back on demand and first in line, it makes banks inherently unstable and subject to runs, and that is true. But it cannot be true that this is the difference between the US and Canada. Okay? Because in the US, you had runs again and again, decade after decade, and in Canada, you didn't. And it has to be something additional to these unstable banking systems, to the fact that bank deposits are inherently unstable. And in the 1800s, up until the 1990s, it was something called unit banking. And you guys are going to be too young to really remember how just stupid, crazy the US banking system was up until the 1990s. Okay, there was no cross-state banking. When I came as a graduate student to Chicago, I came from Massachusetts. Okay, the bank in Massachusetts was not allowed. It was illegal for them to open up a branch in Illinois. Okay, and in fact, in Illinois, if you had a bank, you could only have one office, only one building. Okay, First Chicago was one of the top 10 banks in the country. Okay, and great. I wanted to open, my checking account at a solid, large, well-run bank. No. If I wanted to go and cash a check, this was before the days of ATM, remember? If I wanted to go cash a check, I would have had to get on the railroad and go downtown because they were only allowed to have one office, their central office downtown. Crazy way to run banking. Okay. So no cross-state banking. Many states, Illinois was included, had no branching. In 1914, the US had 27,349 banks. 95 of those had no branches. They were just a single building, small little banks. And that sounds really great. They were very local and so on. But it meant that they were not nearly large enough to reap economies of scale or diversification. Their customer base was only in that small town that they were based in. And if that small town got into trouble, the bank got into trouble. Okay. Now, Canada was completely different. In 1890, they had 38 banks. Okay. And if you look at the population, that was 126,000 people per bank. In the US, it was 3,600 people per bank. And in my class, I go through some of the statistics and just some of the simulations to show how unstable that makes these small US banks. A little bit of an error, a little bit of a problem at a bank, and the bank goes under. And these banks in Canada were big and stable. And if a branch got into trouble, if in Saskatoon, Saskatchewan, a branch got into trouble, they would telegraph and they would, from Ottawa or Toronto or Montreal, they could put, a box of cash onto the train and send it overnight. Okay, everybody knew this. The banks were stable because they didn't get into trouble if there was a little bit of a problem at one of the branches. Okay, so the US banking system was inherently fragile, partly because the way deposits are set up, payable back on demand, but largely because any modest economic shock, an earthquake in San Francisco, a severe economic recession, the bursting of a speculative bubble in copper, these were all things that were going on in 1906 and 1907. The failure of a local bank, it could make customers nervous and want to withdraw their money, and it could start a run on the bank. Okay. A small local bank cannot call on headquarters to ship out more cash. And if too many customers want to withdraw, the small local bank has to shut its doors, making the surrounding customers even more nervous. So here's a nice quote from Friedman and Schwartz. In a unit banking system with some 20,000 independent banks, the impact was bound to be uneven, the impact of some liquidity problem. Forced some banks into suspension and to threaten a chain reaction involving a cumulative increase in the desire on the part of the public to convert deposits into currency. That's the summary of the problem. Okay, so there's a question in chat. What was the logic for this policy area? So Jose, I don't think we can. I'm not sure we. So I'll just read your question. It was a crazy policy. But if you look back to the 1790s with Alexander Hamilton, it was really a sort of political. I won't say fight, but political tension between the Federalists on the one side and what were then called the Republicans on the other. But it's not the same Republican Party as today. And in the 1810s, 20s, and 30s, the US, so in the US Constitution, any powers which are not explicitly delegated to the states, which are not explicitly reserved to the federal government, get delegated to the states. And so the chartering of banks was not explicitly written into the Constitution. And so that devolved to the states. So the states had the power to charter banks. And what happened over the period of about 1800 to 1830 was that there was a coalition between populist agrarians, so small rural interests, agricultural interests, and small town bankers to put into place restrictions state by state against interstate banking and against large banks. Because of course, for those small bankers, it protected their turf and protected them from competition. It was an anti-competitive policy. And the agrarian populists, they didn't like the large East Coast bankers. And so it was put into place. Why did it last for 150 years? I still don't fully understand. But I think it's a testament to the really durable nature of certain political coalitions. And so I think, understanding economics is much more than just understanding economic theory. It's actually understanding things like the durability of political coalitions. So again, sort of that's one of the, I think, the strengths of Harris is combining both thinking of economics, thinking of political science, and the statistics. Those are sort of the core courses. Okay, so that's the answer to that. I'm just going to read, how does consolidation prevent banking institutions from speculative behavior that can lead to financial crisis? Yeah, I know everybody talks about speculative behavior, but you know what? Boy, my personal experience and even more reading history, speculation has almost nothing to do with the banking crises that have happened in the US. Banks get into trouble over plain vanilla banking. Mortgages, what happened in 2008 was mortgages. What can be more plain vanilla than mortgages? Okay. And so, people talk a lot about speculation, there's Volcker rule and so on, but you know what? A lot of it just comes down to plain vanilla banking, commercial banking, making mistakes in commercial loans, making mistakes in mortgage loans. So have American banks behave systematically more speculatively than Canadian banks over time? I don't think so. So, I mean, I don't have sort of good evidence that I can pull up at the moment, but just, all of my experience is that it's plain vanilla banking and not speculative trading. Okay, so let's go on. So how do we break this vicious cycle of a bank run? There's sort of 3 ways or 4 ways to do it. And we'll talk about the 3 ways. You can make banks big enough. So Canada did, okay? They have economies of scale. in terms of being able to diversify geographically, to diversify their customer base, to be large enough to absorb shocks, law of large numbers, to be able to ship cash around the country, to be able to spread the costs of back office things across a large number of branches. So that's number one. US said, no, we're not going to do that. Number two is restricting conversion. Tell customers they cannot convert deposits into cash. We'll come back to that because that's what happened in 1917 and did not happen in the 1930s. And the third is to have someone lend cash short term to any bank in trouble, right? If the problem is, and this is what a bank run, this is what is a bank run. A bank run is customers trying to get their cash out, and the bank doesn't have enough cash sitting in the vault. So if you have some way that you can lend to that bank on a short-term basis, if you have a Federal Reserve that can lend those cash through the discount window or something, that's the solution, okay? And the fourth is deposit insurance. I really should cross that out because we're not going to talk about deposit insurance. In any case, I think there's pretty good arguments that deposit insurance itself came about in the 1930s as a subsidy and as a way of protecting the small, fragile banking system, and is really not a very good way of stopping bank runs. And everybody thinks it is, but I think there's pretty good evidence. So anyway, the US in the 1800s, most of the 1900s, said no to number one, don't allow large banks. In 1907, there was no Federal Reserve, so nobody could do number three very effectively. And four didn't exist. And so the only choice in 1907, as we'll see, was restricting conversion. So let's talk about 1907. So how are we doing, Jennifer? So we're at 5:35. So we're doing okay.
We're doing okay, yeah.
Yeah.
We've got a few other questions that popped in for you, Professor, but do you want to save them for the end or?
Yeah, so let's see. So let me just say, it talked about making banks big enough. Is this true for all geographies? So, you know, that's a good question. I'm gonna defer that. That's not a question I can sort of answer off the top of my head. So that's it. I like that question. That's a good question, but I don't have a good answer to it right off the top of my head. In terms of you, from Victor, I'm gonna completely butcher the name. Does that mean US banks didn't have the trust to decentralize? So there was no federal financial policy, okay? Before the Federal Reserve in 1913, there was no federal, and by the way, huge resistance among state bankers to federal oversight and federal financial policy. And that was the whole fight and debate in 1800, 1810, 1820, was between the sort of the people led by Hamilton, although he died, obviously, as we know, and the first Bank of the United States, which was allowed to lapse. There was a central bank in the United States in 1800, and that was allowed to lapse. And this was just ongoing debate or ongoing tension between states' rights advocates who wanted very decentralized banking policy and federal policy. And so there was never any ability to effectively impose a very strong federal policy up until maybe the 1990s, 1994. What is it? Nagel, I can't remember the name of the act. Okay, but let's go talk about 1907. Fragile banks, there were 27,000 banks in 1914, you know, roughly the same number in 1907. They were small, they were fragile. Economic shocks. So in April of 1906, there was the San Francisco earthquake, which obviously did damage to the economy. In August of 1907, a severe recession started. In October 16th, two speculators lost big on a speculative market thing. But now note, this was speculation not by the banks, but by some bank customers. And so what did it lead to? It led to bank runs. Banks associated with those two speculators suffered runs. On October 18th, the Knickerbocker Trust run started. On October 22nd, the bank Knickerbocker Trust Company failed. So what were the bank responses? So the strong banks in New York, they made loans to the banks. So they were trying to do that third thing of lending cash. But then on October 26th, what did they do? They restricted the clearinghouse banks, the New York clearinghouse banks. They restricted convertibility. What that meant was, if you had an account, a checking account at a bank, you could still use that checking account. You could write a check to somebody. You could write a check to pay your bills, but you could not get cash. You could not go to the bank, give them a check, and get cash out. They restricted the convertibility of your deposit account into cash. Okay, it would be today as if they shut all the ATMs and not allowing us to use credit cards. Okay, so it was pretty extreme, really, really extreme. And it wasn't even clear that it was legal that the banks could do this. Okay, but it was a very effective way of stopping a bank run, because if you say, I'm not going to give you cash, well, then it immediately stops the cash flowing out of the banks. If people aren't allowed to take cash out, the banks aren't losing cash. And so it's a very effective way to stop a bank run. The restrictions were lifted in January of 1908, but we got to understand this was a very extreme measure. Okay? And people at the time recognized and were really unhappy with the extreme measure. The Regal-Neal Interstate Banking and Branching Efficiency Act in 1994. Thank you, that's in chat. Okay, Friedman and Schwartz thought carefully about money. What was happening during a bank run and during a liquidity crisis? Customers and the banks both start to worry about liquidity. They both start, and so what do they want? They want more of the most liquid asset they can find. So in the 1920s or 1907, that was cash. So the demand for cash spikes up. Suddenly people increase their demand for cash. Customers, the public, are worried about bank deposits, and so they switch from bank deposits into cash. The banks themselves, they need more cash. They need more reserves to be able to reassure customers and to pay out customers when it's needed. So importantly, Friedman and Schwartz, they collected and analyzed a massive data. They looked at cash held by banks. They looked at this thing called high-powered money, which was cash held by banks plus cash held by reserves. And this is what we cover in more detail in the financial crises class. But here's the thing, and putting it down in supply and demand framework and supply and demand terms. When there's a liquidity crisis is when cash demand spikes up. So this should be really money, this should be cash. If there's a sudden increase, a spike, a shift out in the demand curve for cash, what's going to happen? The price of cash is going to go up. Well, now here's a thing which is going to take maybe a little bit of effort to get your head around. It only took me, 20 years. What is the price of cash? Well, price of cash is 1 over the CPI, 1 over the price index, because what determines the price of cash is what you can buy with it, all of the other goods. The price of cash is how much cash, how many pieces of paper I've got to give up to buy goods over here. So take my word for it that the price of cash is 1 over the inflation, 1 over the price level. And so when the price of cash goes up, that means the consumer price index goes down. And what is it that we see in crisis after crisis after crisis, 1907, 1930s, 2008 to 2020? We see that prices go down, okay? So in the 1907, 1930s, 2008. And so I take this as kind of the primary lesson from these kind of liquidity crises is during a liquidity crisis, you have to expand the money supply, okay? If you have this big shift out in the demand curve for money, you want to also shift out the supply of money to be able to offset this big shock to demand. Otherwise, you're going to have a huge disruption in the price of money and the price level. And that's going to just mean a big problem in terms of a recession. So kind of the bottom line that I'm trying to get across here is the lesson we want to take away from this is that during a liquidity crisis, you're going to want to expand the money supply. You're going to want to lend cash to banks. Okay. So that's kind of the lesson we're going to learn from 1907, with the same thing in 1893, same thing in 1930s. But let's stop off for a moment in 1913, because that's when the Federal Reserve was founded. There was the recognition that this high-powered money needed to be elastic. You needed to be able to expand it. You needed some federal nationwide mechanism to be able to expand that money supply when it was required. So in December 1913, the Federal Reserve was founded, and one explicit purpose was to issue notes by discounting bank assets, lending to a bank based on the assets, based on the collateral of the bank. It goes back to Bagehot's rules for central banking. Bagehot from the 1830s in London. But these ideas were developed even earlier, it turns out, by Alexander Hamilton. And so these are kind of the two rules for central banking. Lend freely and vigorously. During a liquidity crisis, when banks and the public are crying for cash, lend it to them. And second, lend on all good securities. So that's kind of, so we now have the story that 1907, we kind of learned from the crisis that we want to expand the money supply when there's a liquidity crisis. 1913, the Federal Reserve was founded, which provided a mechanism to be able to do this. Now let's look at the 1930s. What happened in the 1930s? October 1929, stock market crash. And there was a recession, had started earlier, and up through the autumn of 1930, it was a bad recession, but not horrendous. Nothing unusual as far as recessions goes. And then in October 1930, banks started failing. 256 in November, 352 in December. And so this is a quote from Friedman Schwartz: a contagion of fear spread among depositors, starting from the agricultural areas. So now banks have, but remember, unlike 1907, remember in 1907, the banks, the New York City banks, banded together and restricted convertibility. They said, you know what? If we don't do this, we're not sure it's legal, but if we don't do this, everybody's going to go under. Okay? But what was different in 1930? Well, the Fed had been founded. They'd been founded to exactly solve this problem. But the Fed failed to act. They failed. They did not increase high-powered money. They didn't supply the reserves to the bank and to the public that was demanded at that time. And the bank failures cascaded. By 1933, 1/3 of banks were gone. 1/3 of banks is just a horrible, and the financial system basically ground to a halt. I think there's a very good argument that the Great Depression was because of exactly this, the financial system grinding to a halt as a result of the Fed failing to do what they were supposed to do. So here's some numbers. So this is the change in the money, the change in high-powered money. Now look, during 29 to 33, yes, high-powered money grew, but not in the first part of this, okay? In the first part, 1929 through 31, they didn't do anything. And yes, they expanded later, but by that time it was too late, okay? We're gonna come back to 2007 to 2009. So 1929 to 33, it was 1929 to 31 was just like this. The supply of the high power of money was flat. In 31 to 33, things got really bad. The Fed had the power to create new money, but they did not do it. The banking system collapsed. The economy was down by 1/3. Unemployment was up to 25%. This was a disaster, economic disaster. Okay. So why did the Fed fail to act? And it's a critical question. There's no real perfect answers. Friedman Schwartz says the explanation is the shift of power within the system, the Federal Reserve System, and the lack of understanding and experience of individuals. So Strong, who was William Strong? I can't remember, but his last name was Strong. He was the president of the New York Fed. He died of tuberculosis in 1927 or 28. It's a pretty strong argument that if he had survived, if he had been strong, and if he had been the head leading the New York Fed in the 1929-30 era period, that the New York Fed would have responded appropriately, and he would have provided the leadership for the whole system, which would have, led to a much better outcome. But it's Benjamin Strong. Sorry, I wasn't even reading my notes. So Benjamin Strong, he died, and there was a power vacuum, and there was neither skill nor knowledge at the Washington Board of Governors. I think it's arguably one of the most unfortunate deaths in the early 20th century. And so again, quoting from Friedman and Schwartz, true that small events at times have large consequences, and that such things as chain reactions and cumulative forces. And I think this is what was happening in the 29, 30, 31, 32 period. And a banking system, one that's like the US is fragile, is precisely the kind of event that can trigger a chain reaction. Okay. Let's talk about the 1960s. So I want to go, I'll come back to some of the questions, but let me just go, because I want to finish up with 60s and 2008. Following the Great Depression, it was commonly thought in the 40s, in the 30s, 40s, 50s, that the monetary policy had actually been passive or ineffective during the Great Depression. Friedman and Schwartz, with their book, A Monetary History of the US, they effectively rewrote history. They went back and collected a huge amount of data, really good analysis. They argued persuasively that money matters, and it matters dramatically during a liquidity crisis. So Milton Friedman, this is from a review, I should quote, but these people say their monetary history is perhaps the most influential work in economic history of the 20th century. The book, a perfect combination of historical narrative, empirical work, and theoretical analysis, was the major force in refocusing the economics profession's thinking about the importance of money in generating cyclical fluctuations. It also showed how the severity of the Great Depression was in large part due to the mistakes of the Federal Reserve. This is the key thing. There really was, I think, the Federal Reserve that caused the Great Depression. So now let's go to 2002. And this was, there was a conference in Ida Noyes, which is a building on the other side of the Midway from Harris. It's part of the University of Chicago campus. And there was this conference to celebrate Milton Friedman's 90th birthday. Milton Friedman and Anna Schwartz were both there, 90, 91 years old. They were both strong and feisty. Ben Bernanke, who at the time was a member of the Board of Governors and later became and was during 2008 the chairman of the Board of Governors. He gave one of the papers discussing Friedman and Schwartz analysis of the Great Contraction. And the end of his paper was electrifying, at least electrifying as far as academic conferences go. Because remember that Bernanke was a member of the Board of Governors and was going to later become chairman. And he ended his paper by saying, let me end my talk by abusing slightly my status as an official representative of the Federal Reserve. He then turned to Friedman and Schwartz. I would like to say to Milton and Anna, regarding the Great Depression, you're right. We did it. We're very sorry. we meaning the Federal Reserve. But thanks to you, we won't do it again. That was 2002. Now let's fast forward to 2008. Okay. In 2008, what did the Federal Reserve do? So look at this. Their high-powered money, which is the combination of cash to the public and reserves to banks, increased by 69.9%. Okay, let's look at the picture. Okay, look, this is reserves. Okay, this number looks like zero, but it's not. That's what banks held as reserves prior to the fall of 2008 financial crisis. It exploded. The Federal Reserve did exactly what they should have done from learning the lessons of 1907 and the 1930s. And Ben Bernanke, he was right. I mean, you know, when he said in 2002, we did it, we learned, we won't do it again. This was the result of Friedman and Schwartz. Okay. So, you know, these are in 2007 to 2009, the Fed, they did learn, they did the right thing. They massively increased high-powered money. It mainly went to bank reserves. Banks were panicked. Yeah. Now, we can't say for sure what would have happened, but 1907 and the 1930s give us a pretty good idea. If the Fed hadn't done quantitative easing, the financial system would probably have collapsed. Okay. Now, what happened? Okay. Prices between 2008 Q3 and 2009 Q1 fell by 4.1%. Exactly kind of what we would expect during a liquidity crisis. Demand for cash, demand for money goes up hugely. Now they increased the supply, but even having increased the supply seems not to have been enough. I mean, fall of 4.1% was not a huge fall, and it only was for a short period. Okay. So now I've ignored, I've glossed over some things. Since the 1990s, the US banking system has become a national system. And because I can now open a Chase account in Illinois, it's not limited only to New York. The reasons for the 2008 crisis were not really the same as 1907 and the 1930s. Okay, it's a new story of political banking coalition that led to mispricing and overconsumption of mortgage risk. There's also some technical issues really important with respect to the Federal Reserve paying interest on reserves. But I think the central story of Friedman and Schwartz, through their monetary history of the US, teaching both the economics profession, but also the Federal Reserve about monetary policy and monetary, how to manage monetary policy, is kind of a good argument that they did save the world in 2008. Okay, so that's it. So let's see, there are questions. I'm gonna scroll back. Jennifer, can you tell me, I haven't been watching the questions as much.
I've been keeping an eye on them. Maria had a question about the SEC. She said, I read that an official from the SEC said they think the 2008 mortgage crisis was partly because regulators are too highly specialized. Insurance regulators, mortgage regulators. There should be regulators who oversee all the markets because the credit market is interrelated. What do you think? Yeah,
so that's a good point. I think that is a valid point, but unfortunately, I don't think it's the central issue. I think that would help, but it would help on the margins. You're absolutely right. The US regulatory system is fractured, it is fragmented. I mean, and having worked in banking and trading in the US and in Britain, it's just a lot more efficient in Britain. But I think the fundamental problem, and this is more sort of speculation. It's more sort of speculation on my part. It has more to do with the difficulty in allowing banks to fail gracefully. So think about what happens when a bank fails. When a bank fails, all of the customers, the next day are in dire straits. Okay, if you want to have a bank go into bankruptcy, you need to have it close at 5 p.m., work overnight to reorganize it, and have it open up at 8 a.m. or 9 a.m. the next morning, reorganized. Okay, you kind of have overnight or over a weekend to reorganize a bank. And contrast that with General Motors, for example. When General Motors goes into bankruptcy, oh, by the way, they went into bankruptcy in 2009 or 2008, right, as a result of the financial crisis. The company can keep operating, okay? You can go to bankruptcy court and you can have, work out mechanisms for short-term financing, for bankruptcy financing. You can reorganize the contracts. You can reorganize the debt. You can make the shareholders take a haircut. You can make the bondholders take a haircut. And you can organize that over a period of months. For a bank, a financial institution, you don't have that leisure. And there's no good mechanism that I've seen. There's no easy way to allow a bank to gracefully go into bankruptcy and have the shareholders lose their money. Because what you want is for shareholders to be absolutely scared that a bank is not behaving properly. And therefore, you're going to have the shareholders who are sitting over and looking over the shoulders of that bank like hawks to make sure that they're behaving properly. And you're not going to have just one or two regulators, but you're going to have thousands or tens of thousands or hundreds of thousands of investors who are there to discipline that bank. But to be able to have those investors disciplining the bank, you have to have them at risk of losing their money. And if you don't have a very easy way to have a bank go into bankruptcy, then it's hard. And so what's happened, I think, over the past 10, 20, 50 years is there's been government bailouts of bank investors. That's a large extent what you had in 2008. And so it's taken the risk away from bank investors. And so they have less incentive to discipline the banks. So that's actually getting into a sort of not a side argument, it's a central argument. But it's not something I've sort of prepared slides on. So I think I'm going to end there. And we're kind of out of time. Jennifer, other questions that we should.
Let's see. There's a few. Let me see if I can.
Yeah, I see.
I know we're coming up to time. There's a question about if there are regulations that act as threats to bank profits and result in excessive lobbying, how dangerous is capture theory in modern day? How do we get around to ensuring the right policies and regulations are in place without corrupt influence on big banks?
Yeah, no, I mean, so who's asking that question? I mean, that's a good
Raphael.
Okay. Yeah, I think that's a very good question. And the idea about industry, so the bank capturing the regulators, is a really important set of ideas. And I think it applies to a large extent to banks as well as many, many other industries. It is, by the way, a set of ideas which largely came out of people like George Stiegler, Sam Peltzman at the University of Chicago originally. I think one of the ways to get around that problem is to rely less on regulators and more on investors to discipline the banks. But to have investors discipline the banks, you have to have the investors, substantively at risk from losing their shirts. And by the way, think back to 1907. You had investors in banks. Who are some of the investors in banks? They're people who lend money. They're the people who put their money into a checking account. You and I are lending our money, okay? Nowadays, we have no risk in that bank. I don't care much how the bank is behaving because I know that it's federally insured. That has a lot of good things, but it also takes away the incentive for me as an investor in the bank, because remember that if I open a checking account, I am essentially lending money to the bank and I am an investor in that bank. It takes away any incentive I have from worrying about and trying to monitor and discipline that bank. So a lot of the mechanisms that we've developed over the past 50, 100 years have had the perverse effect, I think, of reducing the discipline effect of markets and investors on the banks. It's not saying that regulators absolutely have a role, but I think that the discipline that investors can provide is also very important. And trying to figure out how to reinforce that would, I think, go a large way towards improving situations. But anyway, that's really kind of off topic. It's not off topic, but it's not what I have to talk about this evening.
There were a few other questions, Professor, that were about issues related to international systems. So I've sent a note to everybody that there are other international development classes at Harris. If you email Harris admissions at uchicago.edu, we can try and connect you with kind of the right information. Professor, the last question that I would ask of you is any advice on things that students should read before they come to Harris in the fall, or what you love to have students know before they take your class?
So that's a really good question. So there's two sets of classes. One is the financial crisis class that we've been talking about today. The other is the microeconomics. So microeconomics, oh boy, you know, I need to think better about that, of sort of what's a good micro book to read beforehand. I'm going to say, but I can tell you that my co-teachers won't agree with me. So McCluskey, Deirdre McCluskey, who was my first economics professor. There's a book which is out of print, but it's available on McCluskey's web. And I think it's not called Price Theory, but it's a rather sort of, I can't think of the word, but iconoclastic view of economics, but I like that. In terms of this, financial crises, Calomaris and Haber, that is the best. It's a fun book. It's a little bit heavy going because it's pretty academic. The book by Kindleberger, Manias, Panics, and Crashes. That is a fun book, particularly if you can find an early edition, say the second or third edition, because the more recent editions with work by Robert Aliber, I think, are less good. So.
Well, Professor, thank you so much for the extra time. I really appreciate it. I know everyone appreciates it too.
Yeah.
Looking forward to, hopefully I'll see you in Keller soon. So thank you, everybody. Thank you so much, Professor.
Okay.
Yeah. Bye. Have a good night.
Thank you.
Bye. Bye. Bye.
Thank you.